What if the biggest move in silver didn't happen during the crash, but before it? What if the most powerful players were already positioned, while the rest of the market was still calm, confident, and completely unaware? Because just days before silver collapsed, JPMorgan made moves that now have people asking one uncomfortable question. Was this a coincidence, or something more? Welcome back to Silver Pules. And if you're watching this right now, you're probably trying to make sense of a silver market that feels increasingly unpredictable, emotional, and unfair. You're not alone. This video isn't about accusations. It's about timing, patterns, and asking the right questions when the data doesn't sit right. Before we go deeper, take a quick second to like this video and subscribe to Silver Pules. It helps this channel reach more people who are looking for calm, clear silver market analysis instead of panic and noise. Now let's talk about what actually happened. In the days leading up to the silver crash, the market looked relatively stable on the surface. Price was holding. Volatility was muted. Most retail traders were positioned for a bounce or at least sideways movement. Confidence hadn't disappeared yet. But behind the scenes, positioning was changing. Publicly available data showed that large commercial players were quietly adjusting exposure. Short positions were being reduced. Risk was being managed. And then, suddenly, silver collapsed with stunning speed. This is where the questions begin. JPMorgan is not just another bank. It is one of the largest players in the precious metals market, with deep involvement in futures, options, vaulting, and physical silver logistics. When a player like that makes significant positioning changes, it matters. The key issue isn't whether JPMorgan caused the crash. That's not what this video is about. The real issue is timing, because when large institutions reduce risk just before a violent move, it raises a question that retail investors are rarely comfortable asking. How did they know when others didn't? Financial markets are not driven by headlines. They are driven by liquidity, positioning, and information flow. Large institutions don't trade based on emotions. They trade based on probabilities, models, and access to data that most participants never see in real time. This creates an uneven playing field, especially in markets like silver, where paper contracts vastly outweigh physical supply. In the days before the crash, liquidity in silver futures was already thinning. That matters. When liquidity drops, price becomes more sensitive to large orders. Few aggressive moves can suddenly cause outsized reactions. Now imagine knowing that liquidity is weak, that speculative positions are crowded, and that volatility is likely to spike. You don't need inside information to see risk coming. You just need better tools and experience. This is why the phrase inside game is tricky. Markets don't always require secrets. Sometimes they only require perspective. When the selling finally hit, it wasn't gradual. It was violent. Stops were triggered. Margin calls forced liquidation. Algorithms amplified the move. The price fell faster than most people could react. Retail traders didn't stand a chance. The psychology of this kind of crash is brutal. When price falls fast, people assume someone else knows something they don't. Fear spreads. Logic shuts down. And selling becomes contagious. This is where the narrative shifts from charts to emotions. After the crash, attention turned to who was positioned correctly, who reduced exposure early, who avoided the damage. And JPMorgan's name kept coming up, not because of rumors, but because of publicly reported positioning changes. Again, this doesn't prove wrongdoing, but it does highlight a structural reality of modern markets. The biggest players operate on a different timeline. Retail reacts. Institutions anticipate. Silver has always been especially vulnerable to this dynamic because it trades like both a monetary metal and an industrial commodity, creates conflicting pressures. Add leverage on top, and you have a market that can snap violently when sentiment shifts. Another important factor is narrative control. During calm periods, silver is ignored. During crashes, headlines explode. By the time fear dominates the news cycle, the most informed players are often already done repositioning. That's not manipulation, that's preparation. The uncomfortable truth is that most retail investors enter markets late and exit them emotionally. Institutions do the opposite. They reduce risk when confidence is high and add risk when fear peaks. This is why watching positioning matters more than watching price. At Silver Pules, we don't believe in conspiracy thinking. But we also don't believe in pretending markets are perfectly fair. They aren't. They never have been. And silver, more than most assets, exposes that reality. So where does that leave you right now? First, it means panic is not a strategy. Selling simply because price already collapsed rarely ends well. Second, it means understanding market structure is more important than predicting headlines. If silver truly was finished, institutions wouldn't bother managing positions so carefully. They would walk away. The fact that positioning is actively adjusted tells you silver still matters. Volatility is not a sign of death, it's a sign of stress. And stress often comes before change. Looking forward, the key question isn't whether JPMorgan moved early. The question is whether the market has finished digesting this shock. Has forced selling ended? Has leverage been flushed out? Has price stabilized enough to allow real buyers to step in? Those answers take time. What we do know is this. Every major silver cycle has included moments that felt unfair, confusing, and emotionally exhausting. And every one of those cycles eventually reset. The danger is not volatility. The danger is reacting without a plan. If you're watching silver right now, the smartest move may not be action, but observation. Watch how price behaves after fear peaks. Watch how volume changes. Watch how physical demand responds. These signals will matter far more than dramatic claims or viral tweets. If you've stayed with me this far, you're exactly the kind of viewer Silver Pules is built for. Make sure you're subscribed, because the next phase of this market will reward patience and punish emotional decisions. Before we wrap up, I want to hear from you. Do you think institutional timing is simply experience and better data? Or do you believe silver is a market where the biggest players always move first? Drop your thoughts in the comments. Healthy debate makes us all sharper. If you know someone who's confused by this crash, share this video with them. Understanding structure beats reacting to fear every single time. No matter where silver goes next, remember this. Markets don't move to be fair. They move to test conviction. And the ones who survive are usually the ones who stay calm when things feel uncomfortable. Thanks for watching Silver Pules. Stay grounded, stay curious, and I'll see you in the next update.